Thanks so much for tuning into today's talking point. I'm your host Nilesh Shah. It's an important day to be talking about what could happen in the near term, actually, but not predictive in nature. More about what's happening to the global macro and then the impact on Indian markets, if any. Of course, since we have Nilesh Shah of Envision, we'll never shy away from asking him about what is it that he thinks the micro could do as well. Nilesh, great having you as always. Thanks for taking the time out.
Always a pleasure, Neeraj, being on the show with you. Thank you so much.
Thanks. Nilesh, two or three quick things. Maybe the Italian banks windfall tax is too isolated an issue, but the Moody's downgrade of US central banks, does it bring back the nightmare for risk assets for what happened to them when the first instance of the problems at the US banks came in, or even this is not as big per se?
Well, this continues to be a huge challenge, and it continues to be a huge headwind for the global financial markets. I think what started emanating towards the end of last calendar year and the start of this calendar year as well, somehow through some resolute action by policymakers, a crisis then was averted. But we really are not too sure if that crisis has totally been averted or that's like totally behind us. And this rating downgrade yesterday clearly reminds us again of that challenge or that crisis. So it comes in like as a very timely reminder, saying is that it's not that we're totally out of the woods, and these things can persist for even a longer time. So I still think that yes, the markets, and there has been a very strong risk on trade over the last few months, but we need to remain mindful of the challenges that the world continues to face, particularly the developed economies.
Okay, but difficult to kind of quite put in I mean, I'm just trying to think. It's difficult to square the circle currently when it comes to what impact could this particular thing have? Because when the first instance happened, there was a large impact on risk assets. This time around, difficult to kind of predict that completely.
Yeah, Neeraj, I think when it last happened, in the sense when it first surfaced, maybe 6 or 8 months back, at that point of time, the markets essentially were relatively more quiet or more sedate. And that is because, we had consolidated for a period of about a year and a half by then. Versus that, today the markets have risen. And they are at levels at which there is really no room for any complacency, or there is no room for any kind of, where a challenge can be easily accommodated. We are no longer at those kind of levels. So we have to keep in mind that currently the markets are at a very, very different kind of position. So I think that is the big difference between then and now. Though when it came first surface, obviously there was a knee-jerk reaction, but I think we soon came out of it when there was clearly a very strong action from the policymakers. This time around, we will have to see, and it's about a downgrade of specific banks. So I think we will have to be a lot more watchful and a lot more vigilant this time versus when it first came in 6 or 9 months back.
Got it. The other global piece, which is kind of been around and buzzing around the year, has been China. And this morning, there was some news flow and some articles that I read, Nilesh, about how the property sector might actually be in a bigger quagmire than what was earlier envisaged. And if indeed that unravels or starts to unravel, then there could be an impact, at least in that economy. Now, my question is, can it actually snowball into something that impacts the EM in the Asian landscape as well, or could it remain isolated to China? I don't know if you've looked at it, but if you have, would love to understand your opinion.
Oh, absolutely. I think, Neeraj, the data from China, which is coming out, I think is clearly doesn't augur well for the global economy. Because China is now a meaningful part of the global economy. It drives global economy and it contributes quite significantly to global growth. So it surely impacts China as an economy, and it surely is going to impact global trade. And so to that extent, one has to essentially be very careful. I don't see the China problem spilling over into emerging markets. And that's because clearly China has clearly not been a favorite of investors over the last year and a half. If at all, there are incremental allocations which don't go to China. I clearly believe that actually the rest of the emerging market pack will become a huge beneficiary, including India. So I would probably right now say that what is bad news for China is bad news for the world, but I think it's good news for India. And I think also keep in mind, purely from a geopolitical perspective, I just feel that it puts India into even a more stronger footing in context of Quad, in context of the global economy, in context of emerging markets. I think from all of those perspectives, I wouldn't be surprised that India emerges to be, it is already emerging to be a hot favorite, but I think it emerges to be even a stronger favorite. And that if China was a country specific recipient of allocations, it's quite possible that now that seat is occupied by India. It's not going to happen overnight. But I still think that India now has a strong shot to go and occupy that center seat in the world of emerging markets.
Nilesh, you would know this very well. You are an advisor to a bunch of these global institutions. You probably manage money for some of those as well. What is it? I mean, are people talking about longer term changes in incremental annual allocations to India versus what it would have been in the past?
Oh, absolutely. Neeraj, I think the big change that we are beginning to see is, people going from underweight to equal weight on India in the emerging market pack and from equal weight to overweight. Now, that's the first level of change which is beginning to be visible. But I think a big moment will come in when India itself becomes a country specific allocation, where it is not about India's share in the emerging market pack, but India's share as a country in the overall allocation of global equities. And I think that itself is going to be a very, very big opportunity. And I probably think that that situation is maybe a few quarters away, maybe a couple of years away, hard to time it. But I think when that happens, it will be quite significant. I dare to say that that actually will just not be a flow, it will be a tsunami of flow.
So, Nilesh, in light of that, how are you looking at our markets per se? I mean, there is always this concern about Indian valuations, but the growth numbers, I mean, yes, volumes haven't been quite up there in quarter one, but the profit numbers seem to be okay, at least at the start of the year. Are you comfortable or are you not with where we are currently on all the indices, large and the SMIDs?
Neeraj, I think global allocators always have an issue with India's valuations. It's not something new. India traditionally has been enjoying premium valuations and continues to enjoy so. But that's because India offers two very unique attributes. One is longevity of growth. Nowhere on planet Earth today do you see an economy which is going to sustain a 6 to 7% growth in real terms and maybe 11 to 12% growth in nominal terms. That is twice probably what China is going to be, and that's going to be 3 to 4 times of what the United States is going to be. So India is offering you higher quantum of growth, it's offering you longevity of growth. And that is not just by some few percentage point, but it's by 2x, 3x is the differential in growth. Number one. Number two is, apart from longevity of growth, it's essentially efficiency of capital. Corporate India has been hugely capital efficient. And the kind of return on equity, I mean, today India is one of those very few markets where return on equity is twice the risk-free rate, which means if our 10-year GSEC trades at about 7% yield, the return on equity for Nifty 500 companies is at about 14%. So that's twice. So you have more than twice the growth rate, you have more than twice the capital efficiency versus your own risk-free rate. I think we have to keep in mind our valuations in context of these two attributes, and that's, I think, very, very important from where pricing of equities really comes in from. This essentially is the root or the bedrock of the source of valuations. So I think we have to essentially look at our valuations in context of both these things. Coming back to basically in terms of opportunity and again how valuations look in absolute terms. See, look, again, I think there is still a catch-up game going on. We consolidated for a year and a half. In that year and a half, when the world was struggling, our economy continued to grow. We closed the last financial year at 7.2% GDP growth. Our corporate earnings are very strong. Even the just most recently or about to be completed earnings season for the June quarter, I think it's been a stellar earnings season. Leave aside one or two sectors, but I still think you see a very large set of companies where the earnings growth, the revenue growth, and the earnings growth has been phenomenal. Now, because of the up move that we have seen over the last 4 5 months, can markets, correct 5, 10, 15%? It's quite possible. I mean, that's like pretty much par for the course, and we should perfectly be fine with it. But honestly, are our valuations at alarming levels? I don't think we are at any kind of alarming levels of valuations.
Okay, you've usually been somebody who looks for intrinsic value and stocks available not necessarily at a discount but at a relatively better valuation than the intrinsic values might be. We're starting to see some bit of that in businesses which were bombed out for the last 12 to 18 months, and the market reactions to either good numbers or even bad numbers is pretty strong in pharma, in spec chem, maybe even in private banks which haven't necessarily rallied. Where is it that you are finding favor currently, Nilesh, to put incremental money to work?
So, Neeraj, we still think that some of the long-term structural growth stories, I still think are kind of yet very compelling, very attractive, especially from a more longer-term horizon. Some of the areas which stand out clearly out there are the discretionary consumption side. Okay, so I think that's a hugely kind of a compelling case, especially a business or a sector like alcoholic beverages. I think is really well poised. Growth is fantastic. Margins currently have been under pressure for the last maybe 4 to 6 quarters, but basically they are now coming out of that subdued margin zone. But I think something like alcoholic beverages and the larger opportunity of discretionary consumption as consumers start earning more, they become more aspirational. Demographics are changing. Demographics are evolving. Socio-cultural habits are changing. So I think a huge beneficiary of all of this essentially is the discretionary side. Okay, and I kind of say it like basically, this is the daru and the dikhawa space. Both these spaces essentially is where there is really a very big set of opportunity for the very long term. The two, Neeraj, is the kind of the new age kind of companies, which people call them as the new age, but I would probably call them as essentially businesses which are using technology to serve underpenetrated markets. Okay, so be it online insurance, online broking, online credit, online food delivery, all these kind of spaces I think are very interesting opportunities. Yes, we've got to be mindful. Over the last 6 months, stock prices probably have doubled in some of the cases, but it's like a glass half full, half empty. You could flash back a year and a half and say the prices are still down 50% from where they were a year and a half back. So that's the second big opportunity. The third big opportunity with Neeraj I see is in very specialized technology services companies, or companies having deep technology capabilities in areas like mapping, navigation, geospatial, those kind of areas. Now, these are all very unique set of opportunities, very niches, but hugely compelling, hugely attractive. So we've been trying to just kind of having our eyes focused on trying to kind of identify these kind of opportunities and have them as part of our long-term portfolio. The other area which I think is beginning to look good is the consumer space, where now margins are coming back. They all had suffered hugely over the last year and two because of high inflation, high input costs, and which was impacting margins. I think now margins are coming back and normalizing. So that should again, as a sector, come back. It may not offer very high growth in revenues, but it may just give you that 1 2 year kind of a kicker where revenues will still be single digit, but earnings growth could be double digit. So these are some of the areas. Apart from that, some medium-term opportunities around capex companies, manufacturing companies, auto component companies, defense companies. I think that also is an interesting vertical. So I clearly believe that we continue to see opportunities across short term, medium term, and across the very long term.
just one question, because obviously there are, I mean, many swallows would the summer make, so to say, if there is a saying like that. But my question would be, what would be the first amongst equals out there, Nilesh? I mean, because there are a clutch of things out there that you might be liking. Where is it that you are most overweight on?
I probably think right now it should be around discretionary consumption. That's one area I think, and followed by manufacturing-led businesses. These two essentially would be big. And the third, of course, is financials. If you include, banks and all the online businesses around online insurance or online credit or online broking, if you club them all as financials, I think these would be our top three thematic allocations or sectoral allocations. So it would be discretionary consumption, it would be the financial stack, and it would be the manufacturing oriented segment.
Great. Nilesh Shah, such a pleasure to talk from the very diverse macro to the very narrow micro, and you do both of them with aplomb. Thanks for taking the time out and speaking to us today.
Thank you, Neeraj. Always a pleasure, and good luck for the year ahead. Thank you so much, Neeraj.
To you as well. And viewers, thanks for tuning into this very interesting session of The Talking Point.